Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. I'm the host, Richard Bernoulli. Today is Wednesday, November 5th. We have Clive Thompson and Ira Harris and Judd Hirschberg. Clive is retired private banker, wealth management advisor from Switzerland with a career spanning nearly 50 years. He's known for his expertise in wealth preservation, real assets, his views on the potential collapse of the current fiat currency system, and his latest role was as managing director in the Anglophone Private Clients Department of Union Bancaire Privée, UBP, based in Geneva. Ira's independent trader, past hedge fund manager, and global macro consultant trading foreign currencies, equities, bonds, and commodities for over 40 years. He was also CME director from 1997 to 2003 and also in 2019. We also have today Chief Investment Strategist Judd Hirschberg of White Wave Trading Strategies to help form the basis of some of the discussion with his charts and technical analysis indicators. Welcome, gentlemen.
Thank you.
Thank you.
Great. I thought we'd begin, Clive, with your global macro view on the economy and the financial markets.
We've had a bit of a judder on the stock market last night. Stocks were off, especially the technology sector. And it's quite hard to say if that's just a blip or if it's the start of something bigger. My feeling is that it's just a blip, but I think the consensus out there doesn't agree with me. The consensus is telling us that this is the start of the big decline. And I can understand that because these technology stocks are relatively, pretty overvalued. It's not that they aren't fantastic companies, but the reality here is there's been a lot going around about the circular movements, the incestuous behavior of these companies, where one company pays the second company to invest money back into the first company. And this means that we've seen a lot of reporting that these companies are reporting revenues which perhaps aren't as real as we're kind of used to, meaning that maybe everything is getting very, very inflated and perhaps the profits that we're seeing at the moment aren't as real as people think. But having said that, I think that the money continues to flow into exchange-traded funds, and exchange-traded funds are literally forced, if we're talking about the S&P 500, for example, they're literally forced to buy the stocks in proportion to their weighting in the index. And these top 10 stocks represent about 50% of the index. So with net money still going into the market, and that is the case, that net money has to go into those large stocks, and that's what drives the index higher. So do I think it's over? I don't really think it's over. But of course, we're going to get our bumps on the way, and this is one of them. Would I buy these AI stocks? No, I think they're way overpriced. But I think if you look at the stock markets in general, there's a lot of very underpriced areas that you can go into without having to overpay. Now, the dilemma, of course, is what do you do if you're a professional fund manager? Do you run with the crowd and chase what everybody else is chasing? Or do you go out on a limb and be a loner and buy the stocks which aren't moving at all, but which are very undervalued? And I think that's the dilemma facing fund managers in general. And to keep your job, you tend to run with the crowd.
Yeah, those are all great points. Fully in agreement. Your thoughts, Ira?
Well, we come back to Keynes, right? Do you exercise individuality or suffer reputational risk, right? Because that's what a fund manager is always about. Me, I don't have to worry about that anymore. I just manage it. I only have one client to answer to, and she's playing pickleball now. But outside of that, I'm good. And I agree with Clive. I'm searching for companies that I think will perform, maybe pay me a little bit of a dividend, but see some light at the end of the tunnel. Do I think global growth is over? No. So therefore, I go out searching, and it's what I've been doing through COVID. And there's been some wonderful opportunities, and not, the tech stocks. Okay, you have to have some of this, a little of that, again, for your reputation. But that's not the way I manage my money or what I've ever managed any other client's money. I'm looking for what I believe to be the best opportunity with the least amount of risk.
Well, I agree with you, Tally. I've been retired now for 3.5 years. I don't have any clients. I don't sell any services or provide any investment management or anything like that. So I can invest in the way that I please for myself, and I don't have to follow the rules of any bank or large institution who tell me what I've got to do or what I've got to say to other people. This is why I'm often on LinkedIn writing what I actually think and not what I'm told to write by some large institution which says the house view is 50% US equities or whatever the house view is. I don't have to do that. I can write what I like now, and I invest accordingly. And like you, Ira, I'm looking for the growth stocks or growth stocks at a reasonable price, not the growth stocks at all costs. And if you look hard, you'll find them. There are definitely even entire sectors of the market which I find undervalued at the moment. And when you look around the market, and sometimes you're going off sector completely, you will find some relatively good growth, relatively high growth stocks at very reasonable multiples still, and with dividends. And dividends are what I eat now. I'm retired, so I've got to live. And so, I think dividends are an important part of investing. That does not mean buy maximum dividend stocks, not at all. But it does mean that you've got to get in the portfolio as a whole, you have to achieve a certain level of dividend income, otherwise you don't eat.
Yeah. So we're very simpatico. So let's get into this. So if I said to you right now, and I'll give you back mine, what stocks would you be looking at? Because as we're going to throw this out there, we may as well get right to it.
Okay, well, I don't want to get into the specifics of giving individual stock recommendations, but I'll just talk about a couple of areas where I think that things are relatively cheap. First of all, the healthcare sector looks relatively good value to me. You're getting P ratios often well below 20, and sometimes in the low tens. The oil sector, or the and commodity sector in general, I would say, oil, commodity, mining, and I mean the broader mining sector, not just gold or silver mining. I'm talking copper mining and even iron ore. All of that looks relatively cheap. I think if we look at the gold mining sector, there's plenty of companies which are priced as if the gold price was $2,500, $3,000. And if I factor in an average price of 4,000, by the way, I've done the maths on this on many gold mining, silver mining companies. If you factor in a gold price of 4,000, or perhaps next year's price of maybe 5,000, I'm speculating here, perhaps 2027 price, you'll find that these gold mining stocks, in many cases, will be in a couple of years on price earnings ratios well below 10. And the ones I'm buying are I'm not going across the board in there, but the ones which I go to this sector are the ones which are going to increase the number of ounces they're producing, and therefore they're not making more money because the gold price is going up. They're making more money because they're producing more in ounces.
So interesting. And any particular jurisdictions as well that you like, Clive, in terms of like Latin America, Southeast Asia, within those sectors?
I like to be a global investor and not have too much in any one area. So one of the things I look at when I'm constantly producing lists of stocks, but through various filters and screeners and things like that. But one of the things I look at when I look at the stocks which have come up as potential buys, I'm saying, do I already own a stock in this particular sector? That's my first question. And my second question is, do I already own a stock in this particular country? Or maybe limiting it to maybe 4 or 5 stocks per country, or 4 or 5 stocks per sector. So I do not want to have too much exposure to any one country. But yes, I like certain countries. I mean, I think Hong Kong and Chinese stocks in Hong Kong offer great value at the moment. I was in China just a week and a half ago. I spent 2 weeks in China. I can tell you there is no sign of recession that I can see there. Yes, property prices are down, but the shops are full. People are buying, they're spending. The restaurants are full. There's a lot of activity. Just to give you an example, one of the cities I went to is called Chengdu. It's a city of 20 million people. There's 10 million cars in Chengdu. Now, that doesn't mean to say that one person in two owns a car. What it means is a lot of people own two cars. Why do they own two cars? Because there's a restriction of driving in the center of Chengdu for pollution reasons, according to your number plate. So people who can't get into Chengdu 3 days a week, they buy two cars, one with a number plate and one with another plate, so they can get in. Now, for me, that's a sign of, and everywhere you go, you see these luxury car, I say luxury, they're luxury by Western standards, car manufacturers. That must be, I don't know, perhaps there's 100 car manufacturers in China. I maybe got it completely wrong, but everywhere I go, I see these car shops with fantastic looking cars. They're big, they're SUVs, they got multiple TV screens. I guess some of those are what you have on a standard car in America now. But you know, they're very well kitted out, and they're dirt cheap. I compared the price of the same Chinese car in China with the same Chinese car I could buy here in Switzerland, and it's more than double the price here in Switzerland. Don't know why, but just to tell you, that means they're relatively cheap in China for the average Chinaman.
And do you see any potential geopolitical risk for Western investors to invest in the Hong Kong market, like potential for capital controls of some sort?
Well, sure, there's geopolitical risk wherever you go. I mean, it's not just because of China. I mean, let's face it. I had two stocks in Russia when they decided to close the doors.
So, Ira was there. Yeah, also. Yeah.
But on the other hand, when you have if you don't have too much in an area and then the geopolitical event occurs, there are sometimes opportunities to find a back door to buy something dirt cheap. And Russia's invasion of Ukraine was an example of that, because many stocks plunged because they had some assets in Russia. Now, all of those stocks are back to normal. So maybe they've assets in Russia, they're not not useful now. But those stocks, that was a temporary blip. Everything went down. Oh my God, McDonald's has got a shop in Russia. It doesn't matter what it was, but anything with a business in Russia, the share price plunged. Now, you could buy American shares, European shares, almost all over the planet, because they'd gone down because of Russia. Same thing for COVID. When COVID occurred, there was stuff which went down by unreasonable amounts. For example, we had the advertising companies. There's companies which advertise at the airport, for example. We had the hotel companies went down. The cruise lining company, the airlines went down. Airports themselves, if you could invest in the airports, went down. So there was a whole bunch of things which went down as if they were never going to come back into business, but they were still there. At every moment in time, when you have a crisis of some sort, you've got to look for what will be a survivor, but which is unreasonably being depressed at the moment.
Yeah, good words.
So what are you asking? What else I like? Do I like? So I said China. I said Hong Kong, but of course, South America's relatively cheap if you go into the mineral stocks there, like Vale, for example, and where else do I like? Europe is. Everywhere is cheap compared with America, to be honest with you. But there are cheap stocks in America. UK itself, for obvious reasons, there's been a political problem in the UK and a tax problem. But many UK companies are global companies. They're global pharmaceutical companies. They're global minerals companies. They're selling their stuff all worldwide. The British pound is falling. That's boosting their profits. And the multiples you see are very low.
Mm-hmm. Yeah, exactly. Your thoughts, Ira, on that?
Well,
for opportunities.
Now, I too own some Russian stocks, which I'm still battling about because I don't know where those assets went to. So maybe you have better answers than I do. they supposedly unwound a Russian ETF that Van Eck ran, and I still wonder where my Moscow energy shares are, but I'm sure I'll find out one day. But I just scour the globe. I'm a global macro guy. So, and I'm a top down picker, and it sounds like you are too. So I'll look for areas. So yes, Latin America has been very underappreciated. We just saw with the elections in Argentina, certain results. And I look for, am looking at commodities because commodities, especially relative to equities, have been really underappreciated. So, now I don't tout these things. I don't tout companies. I don't go do, as I always say, go do your own work, figure out what your own risk profile is. But I'll take a look at a company like Bunge, because Bunge has such a huge presence in Latin America. Uh, and as long as China just, uh, of course, reached an agreement, quote unquote, an agreement with the U.S., even though I believe that the U.S. got totally outmaneuvered. And as I say, if we had the Abraham Accords 7, 8 years ago, the tariffs should go down as the ASA Accords because the U.S. sold itself for a pot of beans. All the puns are intended, but there are plenty of opportunities. And you know what? It's very hard for me. But for the last 3, 4 years, I have been a little bit more bullish on Europe, the European financial sector, especially because it's an unloved, underappreciated, and badly managed sector. But I've been bullish, very bullish. Commerzbank. I still remain bullish. Commerce. It's caught up in a little bit of a political upheaval, but I also like UBS, and that has its own problems too. And what the Swiss are going to do, and right back in your pocket is ABB, because if the Ukraine war ends, who's gonna rebuild Ukraine? And I think the Swedish engineering consortium is well positioned for that. So I'm looking at things like just like you. I look around the world. Now it's interesting because I read yesterday a piece on the Swiss pharma industry, which is really uh, getting whacked because the Japanese are also big in global pharma, and with the ultra weak yen, I think uh, why it's weak, we can sit and discuss. But that places Japanese multinationals, especially in the pharma and in the high-end re-engineered product area, very, very competitive. And they're driving on. And it's interesting that Buffett moved so dramatically into Japan 4 or 5 years ago. So, I mean, there are opportunities, and you got to scour for them. They don't fall into your
Yeah,
lap. You got to do your work.
well,
And as Judd does his technicals, the technicals will tell you where your risk reward is and where your potential movements can be. But the underlying fundamentals, you have to dig. And it sounds, Clive, like that's how you approach it. So we're very simpatico in that.
yeah, on Japan, despite the fact the index itself is at an all-time high, there's a lot of very cheap companies in Japan. It's not hard to find bargains. I mean, every time I do a search for or filter for good stocks at good prices with growth, Japanese companies come up all the time. Not all, not it's not a whole list of Japanese companies, but I'm just looking at a list I produced on the screen. You can't see it here. I'm not going to show it because it's got names of companies. But in the top 12, I see three Japanese companies came up as being very undervalued. I don't even know what these companies. You wouldn't know the names of them. I don't even know what they do myself without studying them a bit more. But Japanese companies often come up when I filter for good stocks at good prices.
Mm. Yeah, no, I know, and the Japanese banking is, believe it or not, I like Tokyo Mitsubishi. I think is a great bank. It has an elder population, so it's got money to play with, and it has such a dramatic footprint. I mean, I look to see what UBS has done in the wealth management business in Asia, and it's been phenomenal. And I think it's what's really been driving UBS for the last few years, once they stopped pretending that they were Goldman Sachs and went back into the wealth management business rather than the trading business. I think Tokyo Mitsubishi fills that same void. I think they've been a little lax, but one of their best things is that they own 23% of Morgan Stanley. So why these two can't get themselves together to make a true global wealth management operation? I scratch my head about it, but it's just one of the jewels I think that exists in the global banking or potentially in the global banking industry.
Well, financial stocks, I think in general, are quite attractive. And that's not just the banks, it's also the insurance companies. And the reason for that is the huge numbers of desk workers, people sitting at desks, pushing paper around. And we now know that a lot of what these people are doing can be done by artificial intelligence. So for sure, every IT department is working on making some of those staff redundant. Now, they probably won't, they'll probably, in the early stages, companies will probably just use this to get rid of the inefficient people and say, oh, we're replacing by AI. But I think over the years, more and more staff in these large companies, and it's not just financial companies, but large companies with large numbers of employees will see a reduction in the headcount, and that can only work through to the bottom line. Now, obviously, it's very bad for the employees concerned because it's going to get harder and harder to find new jobs, and I feel very sorry for them. But if you're a shareholder of these companies, you're the net beneficiary of it. And any company which isn't replacing employees by artificial intelligence will find that their competitors are doing it. So it's going to happen whether we like it or not, whether it's good or bad, it's going to happen.
So but let's come back to the commodity end of it. So you're sitting in Switzerland, you understand, and the S&B has certainly been the poster child, the alchemist of the century award, because they've taken Swiss francs, printed the hell out of them, bought real assets, and have really done very well, right? So they're sitting there.
Yep.
So I look around the world and I go, well, and I know from Hildebrand, I guess his wife isn't involved. We don't care about it. But, now Schlegel with, so they're running the show. And I go, why aren't the Swiss starting to move out of sight? They've had Apple, they've had they've been big holders. But then you look and following what you and I have discussed about, which is especially the potential coming of, raw material prices. If I ran the S&B, I'd be selling some of those equities and looking to buy like places. I'm not there yet, but I'm getting bulled up on Canada. Not that Canada doesn't make one mistake after another, they do. But in a world that's chasing rare earths and energy, Canada is a country in search of a people because it's like Siberia. It's so huge and its natural resource wealth is so phenomenal. And it sits there with a currency that when I run PPP numbers and others shows it probably 22 to 25% undervalued on a PPP. So, I'm amazed that more people don't start moving in there and knock on Carney's door and go, hey, as I say, why aren't they should be copying Norway and others and building a sovereign wealth fund with all their massive amounts of minerals and raw materials.
Yep, absolutely.
Meet the Cedar Owl, a new economics and finance publication with a focus on environmentalism. We combine the Austrian School of Economics and market environmentalism principles for investing in a sustainable future. Follow the link in the description to get to know the Cedar Owl better, understand our values, our mission, exactly where we're coming from, and the type of content that we release on a cyclical basis every Thursday. Join us in targeting outperforming portfolio returns while making a positive impact on society and the environment through technology. Subscribe now for weekly insights, investment articles, and exclusive content.
And speaking of commodities, Clive, what are your thoughts on the precious metals, like the major precious metals, gold, silver, platinum? And can you speak to your thoughts on a potential for a revaluation of gold in US dollar terms?
Well, at the moment, we've got, I think, two things helping gold. First of all, we've got strong, very strong central bank buying coming from major central banks, which are not necessarily aligned with the US interests at the moment. There's a move to seek some sort of asset other than US dollars because, I think the view is you never know what's going to happen. On top of that, we've got the situation of ever increasing debt in the United States. It's increasing at about 6.5% a year. That's going to rise probably. And the interest on that debt is rising much more rapidly. 2 or 3 years ago, the interest on the national debt of the United States was about 8% of the tax take. I think this year it's about 18%. So we go in 2 or 3 years, we go from 8 to 18%. And according to the Congressional Budget Office, that's their number, not mine, in a few years, it'll be 22% of the tax take. So we're getting on for a quarter of all taxes collected in America going to pay interest on the national debt. And the reason that interest has risen so rapidly recently is because we come through from a 15-year period of effectively zero interest rates, where the bonds the money which was being borrowed by the US government was being borrowed with 5 or 10-year bonds or 15-year bonds at very low rates of interest. And then we went into this higher interest rate period, which we're now sort of in. So I wouldn't say it's high, but it's moderately higher, which meant that as these bonds mature, which were paying or costing the US government 1 or 2%, they're now having to roll over these bonds into new bonds, which they have to, where they borrow the money to pay back the old money. But the new interest rate is more like 4.5% that they're having to pay. So not only is the interest rate on the existing debt doubling and some, but also as they run these deficits, which are going to be 2 trillion a year next year, or this year actually, because the year started in September from the American point, not only is the deficit going to be 2 trillion, on that deficit, that extra debt, they're also going to be paying these higher rates. So that's why the interest cost is rising. And there's no chance of that interest cost going down for the foreseeable future. It's going to keep rising. So there is a risk, especially if interest rates were to rise beyond a certain point, that the interest cost just spirals out of control. Is it not dissimilar from a family who's got a credit card? Now, I know families are not the government or anything, but if you imagine a family with a credit card, the credit card gets to a certain point, and then at a certain point, the outgoings on their credit card exceed the totality of their income. And there comes a point when the bank will say, we're not going to lend you anymore. Now, to put a parallel with the governments of this world, and I say governments, not just the US government, because it's not just the US which is over indebted. We've got many, many countries which have got debts of over 100% of GDP. There comes a point where public perception of government debt changes to a point where they say, you know what, I'm lending to a country which can't repay, and if they can't repay, they won't repay, or if they do repay me, they're going to repay me in something which isn't worth nearly as much. And then you get what's called a sovereign debt crisis, and you don't know when it comes or where it comes from or if it's going to come. I mean, but historically, it's always come when governments have over-indebted themselves. So it's just a question of more like when. And when you get a sovereign debt crisis, then something has to be done. And there's a variety, and we'll come to the gold revaluation in a second, but there's a variety of things which can be done to either kick the can down the road or to devalue the currency. So I'll just touch now, it falls neatly into something which can be done as far as the USA is concerned, and that would be the revaluation of gold. To keep it simple, if they were to revalue gold using a certain mechanism, which is not different from the mechanism they used back in 1934 on the 31st of January, it would create trillions of new cash for the Treasury, reducing the national debt reduce their debt and allow them to keep all of their gold. Now, you can call it an accounting trick if you like, but it's an accounting trick which has been done and would work. And many countries around the world have done or on a continuing basis revalue their gold according to market prices. So it's not without precedent here. So in simple terms, if they were to revalue gold at today's market price, let's call it $4,000 for simplicity, that would create $1 trillion of free cash, allowing them to keep the gold. I won't go into the mechanics of how it's done, but there's a very simple mechanism where they move the gold to the Federal Reserve, they move it back again, and suddenly the Federal Reserve has issued them a ton of cash. The beauty of doing this is the cash they get for this exercise doesn't increase the debt. There's no interest payable on it. The Federal Reserve gets something in exchange, which is called gold certificates, which are irredeemable. They're perpetual. They bear no interest, and they're not part of the national debt. So that's basically how you create money out of thin air. But the beauty of this is it reduces the national debt. Now, 1 trillion is a drop in the ocean when they're running a 2 trillion a year deficit. So they'd have to do it, if they're going to do it and make a dent, they'd have to do it at a price which is higher than the current market price. And there's been a lot of talk about what number would be the right number. There's people who say it should be tens of thousands, hundreds of thousands. I think the right number should be $15,000 an ounce. And what do I mean by that? I mean, they basically revalue gold at $15,000 and stand as buyer of the last resort of all gold which comes at them at $15,000 an ounce. In the early stages, they'd get a lot of gold coming in, but that would quickly dry up as the gold price becomes underpinned at 15,000 and stays higher than that, because the minute you underpin a price, it always trades higher, as happened as happened after they revalued in 1934 and after they revalued, effectively not revalued, they did revalue in 1971, but they revalued to the floating price, and immediately the gold went up because you could still sell gold back to the Treasury at $35 an ounce, but they weren't selling it to you at that price. The window was closed. So I think, but if you did it $15,000, that would effectively create, and I haven't got the figure in my head, I think it's probably about $4 or $5 trillion, 4 trillion, something like that, of free cash. And that would allow them to, as debt matures this year and part of next year, repay it without having to borrow anymore, so the national debt goes down, whilst at the same time they're funding their expenditure, their deficit, without having to borrow money. And that would buy them 1.5 to 2 years time on this, and then they can repeat the exercise later on if they want to, repetition. But that would be one magical trick. But I think the real, it's only kicking the can down the road. And at one point, we'll get to a situation where everybody says, hey, you know what, we're on a hiding to nothing. This is just playing games with the numbers. And the situation is getting worse and worse. And we've run out of options here. So at that point, you have to have what's called a global currency reset or a debt jubilee. Now, I don't think that means a default. I'm going to explain why it's not a default. Basically, the way that works is you issue a new currency, and everything's getting in place for that. We've got the stable coins, we've got the central bank digital currency coming into place. So when the economy is largely operating on the inverted commas new currency, central bank digital currency, one old dollar is one new dollar, you can change them freely from one to the other. All you have to do is some kind of capital control where you limit the ability to change the old for the new. In other words, if it's a CBDC, which happens to be the case, you limit how much money can be put into your CBDC wallet. Therefore, it's no longer 100 old cents makes one new dollar. Those old dollars are worth less because they're less deployable. And effectively, people pretty soon realize that this isn't a temporary restriction. They realize the word temporary, you can't move your old dollars to your new dollars because of the emergency. It's actually going to become permanent. And that means the old dollars then quickly head towards zero. And don't forget, the national debt of the United States and every other country is in the national currency. So when the economy is operating on the new currency, central bank digital currency, and you can't move the old one to the new one, your old one becomes a defunct currency. So from a country point of view, it's brilliant because if we take the United States as the example, they're starting off with a debt to GDP ratio of 0. so they can bail out everybody who deserves to be bailed out, like pensioners and poor people who have lost money because of the debt jubilee, but they won't be bailing out the zillionaires who live in Africa or Asia or China or anywhere else on the planet. They're all going to find that their dollars are now completely worthless and undeployable.
That's fascinating, and connecting all the dots together. Yeah, your thoughts, Ira?
Well, there's a lot there. The problem with it is, from the role of the U.S. hegemon, goes back to that famous meeting of 1974 with Kissinger and Thomas Enders, that when you do this, and I'm not saying that it's not a doable proposition, you are going to enrich your global competitors, because the Chinese are doing nothing but stockpiling and adding to their reserves. So they're gonna benefit maybe more, and they carry less debt load. So yeah, you can do this. And Clive, I'll say to you, because I've talked about it on this podcast more than a few times. One of your greatest countrymen, John Maynard Keynes, talked about basically this in 1923 with his book, the tract on monetary reform. You know, the 4 things that you can do, basically, to get out from under this. Of course, especially after World War I, when so much debt was taken on by so many sovereign entities. But you can repudiate it. That was his first step, which when you are the global reserve currency, that's a very difficult task. You can depreciate your currency in order to pay it back, which is the age-old way to deal with inflation. You can devalue the currency in one lock. And then, of course, you can have a capital levy. But as you rightly point out, the entire thing is, as Keynes himself talked about, you euthanize the rentier class, which is what you're going to do with what you want to do. So you just have to get rid of all the bondholders who sit there and do nothing but clip coupons. And Keynes despised them. He loved the entrepreneurial class, but he was not a big fan of the stagnant end of global capitalism, the bondholders. So
yeah,
right, where are they going to go? We don't know. I mean, Switzerland's the bastion of it.
I'd add to Keynes's list here. One thing perhaps he didn't say, but there's also what's called the bail-in, where you say everybody who's got a bank balance or a money market fund, now X% of that or anything over a certain amount now belongs to the government. Obviously, we've had versions of that in different ways. I mean, take Cyprus as an example, where everyone with 100,000 or more lost the excess.
Well, I mean, even going back to when the U.S. confiscated gold, basically in 1934. So, I mean, we've seen these things, and again, and I didn't want to interrupt you, but when you started down that road, so now the Fed is caught, as other banks. You know, Europe is no great shakes either. And as I tongue in cheek say, the fact that French yields on the 10-year are higher than Italians are probably the greatest humiliation for the French since 1871. So Europe is in very difficult straits, especially because it's Germany who guarantees the low interest rate that they presently have. Outside, if Germany was not part of the EU, where would yields be in Europe? We've seen them back in 11 and 12 and 13 when we ran into the debt crisis. So we are in. When was going to happen? But basically, the Fed is caught too in the wheels of fiscal dominance, and fiscal dominance is a very serious issue because central banks are now married to the fiscal authority, which is Congress. They're in lockstep because the cost of financing this deficit is huge. And even Marin and Vicente have had to accept that because everything they criticized Leo Brainerd and Janet Yellen for, they're doing now to a greater extent, right? They're just moving down to shorter yield, to shorter duration in the hope that they can resolve this. And it's a hope, because if they're wrong on the inflation end of this, they're in a heap of trouble.
Now, there is one thing which they are doing, which I don't know if it's going. I'm not going to say it's going to solve the problem. It won't solve the problem, but it does help push the problem a little bit further into the future, and that is the stablecoin game. So historically, we had the petrodollar. So you had huge, the Saudis and everybody else who were accumulating huge quantities of dollars, basically funding the USA, the US's borrowing needs. But that's sort of grinding to a halt now as people start to become a bit concerned about holding all these treasury bonds. But now to replace that, they've got these stable coins where they're basically saying, we'll throw stable coins at the world and hope that everyone will say, wow, this is wonderful. We can transfer money on a Saturday night in a microsecond from country A to country B. But behind the stablecoins, every stablecoin has to own, by law, US treasuries or T-bills. So that's obviously a little bit of a game which is going on, which may help the financing for a while, because if it wasn't for the stablecoins, there'd be literally trillions of dollars. I don't know how much is in stablecoins already, but I bet it's a lot. I bet it's $1 trillion. There'd be $1 trillion of money out there looking for someone to lend money to the government.
I scratch my head with the Genius Act because I keep trying to understand it with the stable coin. And I know we're going to end here, but with the stable coins, I'm flummoxed to think, how are they not just a debit card with another name?
Oh, they are. It's just dollars, dollars which are digital. That's it.
Yep. Okay. I mean, I run around in circles with this. I go, how is it different from my debit card? And if the banks were fearful, meaning the commercial banks in the US were fearful, why don't they just pay interest on the debit card? And why would I want to have a stable coin? I know, because I get the blockchain event and the electronic ledger. I get that, but ultimately, if you're not paying me interest, or if you're paying me minimus interest as somebody is siphoning off from the T-bills, but I know we've discussed a lot here.
Yeah, but if you lived in Argentina or Venezuela or Nigeria or tens of countries all around the world, you would certainly find the ability to easily hold stable coins as opposed to bundles of physical dollars quite convenient.
You're right. You're right. But I would also stash my money away in some. I'd have to put some into a hard asset, which had the currency, the historic currency of being a store of value. Dollars, holding T-bills are not a store of value for me. Especially,
well, you live in the Western country. I live in a Western country, so we have the luxury of being able to buy gold easily and store it easily and safely, which is not necessarily the case for everybody everywhere.
no,
but, there are countries where you literally have to wear it around your neck to keep it safe.
I can tell you, on May 14th, we did a podcast. Richard was the moderator with Mark Faber, who I know that you have to be very well aware of. And we spent 20 minutes talking about platinum, because platinum also serves the concept of a store of value. And from that day, from the end of May to, platinum had a 70% rise in price. And now it's, kind of held out here. But you're going to have to search out all types of stores of value because the huge amount of liquidity that sloshes around the system and sees no end in sight, because, it's not in their interest to put an end to it. They're not going to they need to become fiscally responsible. Why does the Swiss franc keep going up? And why do people buy the Swiss franc? Even with rates at zero. You want to talk about a classic currency carry trade, it's the Swiss, but nobody will do that, because the Swiss debt is one of the few places in the world that is under control. And people believe that it will remain under control for the foreseeable future. And the Swiss talk about that they'll even go to negative yields. And people would still buy.
Yeah, I mean, it makes no sense to do the carry trade with the Swiss franc because it effectively means borrowing Swiss francs to buy a high-yielding currency. But the trouble is when you repay the Swiss franc, it's going to cost you a lot more. But on the other hand, you do the carry trade with the Japanese yen, which is a low interest rate currency. In other words, you borrow yen and buy Brazilian real, for example, and you're expecting the Japanese yen to have depreciated by the time you come to repay it.
Right. Except that, again, you're expecting it, and it all depends what they're going to do here.
I mean, obviously things can go wrong, and they often do, and then you'll hear about it on the news that some major institution has either got a massive loss or worse.
We think back to what happened when the Swiss pulled the plug in January of 2015, and all those people in Eastern Europe who had cheap mortgages thrust down their throat, because again, the peg will never break. It's 120. The Swiss euro is at 120, and then it was broken, and they're still suffering under that. And I know the lawsuits are still ongoing. So yes, it'll be interesting. This has been a great conversation. So,
great
poor Polish.
The
Polish. Well, it was very common in Poland to do a mortgage in Swiss francs until the peg broke.
Right.
It's been a great, insightful, fascinating discussion. Just your final thoughts, Clive, and also how can our listeners and viewers learn more about your work? I love your podcast discussions.
So I'm only in two places. I'm on YouTube under Clive Thompson and on LinkedIn under Clive Thompson. You're welcome to join me. I don't sell anything. I've got no products. I'm not on X or any other of these social media platforms. And I just enjoy writing, and most of all, I enjoy investing. So that's what I do.
Great, thanks, Clive and Ira.
We're totally simpatico. I'm on X, and I don't do much on there. Every once in a while, because they post the podcasts on there, somebody does. So I wind up on X. But me too. YouTube and LinkedIn, and the YouTubes are great. I like to go back and watch. I'll watch all mine myself. Now I'm going to find Clive because we are very similar. And again, I'm not selling anything. It's when I used to be on CNBC all the time, and I go, I'm not selling anything. I'm going to give it to you as straight as I know it to be. It doesn't mean I'm always right, but I'm also, because I'm not selling anything, I'm not setting your risk factors for you. You determine what I may give you a global macro view and where there's potential to invest. And we've had some pretty good plays, by the way. Judd will testify to it. We put people into Kansas Southern because of the Mexico play, and it worked out. There are many of those, and you can find them. You can go one end, but you can listen to it, and point you. And it seems like Clive does the same thing. I'll point you in a direction where I think global money, because it's all about the flows of money and where it's potentially going to go, and hopefully get you a little bit ahead of it. But you are going to determine what your comfortable risk level is. You want to pay me $100,000 a year, I'll sit and I'll be an advisor to you. But for less than that, don't even bother calling me, because I'm not going to set your parameters.
Okay, great.
Great.
Yeah. Thank you so much, Clive, Ira, and Judd. Thank you.
Thank you very much. And bye-bye, everybody.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.